Hello and welcome to another edition of the William Buck CPD program. My name is Frank Devoli.
And I'm Chris Bergen.
And we're here today to speak about director penalty notices. I'll get the slides up and we'll throw to Chris to start.
So what is a director penalty notice, a DPN as we're going to refer to them through today? A DPN is a notice from the Australian Taxation Office sent to a director or directors, plural, of a company, making the director or directors personally liable for the tax debts of a company. DPN is issued by the ATO when the company has failed, neglected or refused to pay and or report tax obligations. It might have significant unpaid debt and or it might be under the suspicion of the ATO for engaging in Phoenix activity. Once given, the DPN will give the directors 21 days to take serious action or become personally liable for the company's tax debts. The ATO may issue a DPN if the taxpayer fails to meet their obligations in relation to PAYG, SGC or superannuation guarantee charge, as well as GST. Over to Frank, and we're going to talk about it, go through a case study as we progress through the presentation today. Thanks, Frank.
No worries, Chris. So as Chris said, we're going to present a lot of the facts and information around a DPN through information in a case study. So the case study begins as of the date of 15th of July, year one. So the key facts to remember are the companies in the technology space. There's two directors. The company had a tax debt of $1 million as at 30 June of that year. The debt is made up of PAYG withheld. There was no SGC and no GST liability as at this time. The company started facing some cash flow difficulties due to increased competition in their industry. They were able to negotiate a payment arrangement with the tax office where debt will be paid in 24 equal monthly payments over 2 years. So some further information, the company was able to make 12 payments and then it eventually defaulted on its payment arrangement, missing 2 payments that were due at the end of June and the end of July of year 2. Due to an oversight with the company and its accountants, there were no lodgements made in that 30 June year. And then they stopped engaging with the ATO after the missed repayments. And there was some correspondence which was sent from the ATO, which included a DPN warning letter in November of that year. So I'll just go through some of the different warning letters and correspondence that can be received from the ATO. As you can see there, they do use a color coding system. So at the top there is your ordinary warning letters from the ATO where they're issuing an amount that is owing to the company, to the ATO, that is overdue. So that's your standard first bit of correspondence you're going to get. After that, you can get either one of the two. So that darker red color is usually reserved for DPNs themselves, as well as if the company has missed lodgements. We will get into why that is important later on. And then that third orangey one is a warning, which may be received by the company that the ATO is going to issue a DPN for some unpaid debt. That's the last bit of correspondence that a company will receive prior to getting an actual DPN from the ATO. So Globex didn't respond to the November warning letter and owed $500,000 in amounts on the original tax debt, as well as an estimated $1 million in further PAYG withholding liabilities, which had not been reported to the ATO. So that 500 was for that original $1 million debt that was paid off over 12 months. And then the extra $1 million is some further debt that was missed and not reported to the ATO. On 18 January in year 3, the directors each received a DPN for the unpaid original liability of $500,000, as well as a DPN for the $1 million of estimated amounts, which was not reported. The DPN was sent to the individual residents as noted on the asset company record and was dated 16th of January of year 3. I'll throw to Chris now to go into some further information on how the ATO deals with DPNs.
Thanks, Frank. So the ATO has very kindly provided some guidance, which we'll sort of summarise and go through here today, about when they will consider and when they will issue a DPN. So effectively, the ATO has stated that any taxpayer who is simply not working with the ATO to try to resolve their tax liabilities might be given a director penalty notice. In its guidance, its stronger action policy, the ATO has advised that it's targeting companies that are unwilling to work with the ATO, that have repeatedly defaulted on agreed payment plans. If they don't have the capacity to pay and don't take steps to resolve the situation, so head in the sand approach is not effective to avoid a DPN. And also, if someone's been subject to an audit where the ATO has detected deliberate avoidance and payment avoidance continues after that fact. And also, lastly, anyone who appears to be engaging in Phoenix activity, such as using liquidation to avoid financial obligations without risking assets, with the intention of resuming operations through a new entity. So those sort of standard Phoenix operations, that's when some of the circumstances when the ATO will look to consider issuing a DPN. Once a DPN is issued, there are only two options available to the director to deal with the DPN. So on the next slide after this one, we're going to go through the two different types of DPNs there are. What we call a lockdown director penalty notice, which is the traditional one. And then there's the lockdown director penalty notice, which has an immediate effect on the directors, as we'll go through now. So a lockdown DPN is given when a company's tax liabilities are not paid and they have not been reported to the ATO within the 3 months. And that's for PAYG withholding and GST, or the due date of any superannuation guarantee charge. Paying the debt in full within the 21-day period is the only way in a lockdown DPN scenario the director can avoid personal liability for that DPN. The softer and more gentle DPN is what we call a non-lockdown. So a non-lockdown is a DPN notice requiring the company to take specific action within 21 days, or the director or directors, if there's more than one, may face personal liability. A non-lockdown DPN is used by the ATO when the company's liabilities are not paid, but they have been reported. So the key difference between these two is the reporting to the ATO within 3 months for PAYG and GST, or the due date for SGC. Back to our case study for today, Globex. Thanks, Frank.
No worries. So what you have here is a typical DPN that your client might receive from the ATO. And I've highlighted some key areas here to focus on. Obviously, there's a lot of information that is in here, but if we look at it and break it down, some of the key points. So the first one there is the timing. So a DPN, it's important the date that it is not received, it's the date of issue of the DPN. So there is obviously that 21-day period to respond. It's 21 days from the date of the letter. So if this isn't opened until a week later, it's not 21 days from the date that it's opened or received, it's the date of issue. So that is always important to notice and to look out when you receive a DPN. Method of service is another important aspect of a DPN. A DPN has to be sent to the registered ASIC address of the directors. So that's important to make sure that it is always updated and correct. If it's not sent to that address, then the DPN is invalid and it can be fought on those grounds. And the last point is the breakdown of the debt. So if you want to see or try and work out the difference between a lockdown and a non-lockdown DPN, on the DPN, the way the ATO does show it is through the columns. So on this one, on the page 2, you can see that column 4 is the non-lockdown portion of that debt. So that was the portion that was lodged in the correct time frame within the due date period. And that amount can be avoided by personal liability for the directors by placing the company into administration or doing as is told on that DPN. The other portion, so those 4 payments in column 5, they're a lockdown DPN. The only way to avoid personal liability for those debts is to pay it. And that information is provided underneath those columns. You can see that the ATO discloses how the DPN can be remitted for each column. So how to avoid being personally liable for company tax debt. So to avoid receiving a lockdown DPN, the best way and the easiest way, and really the only way, is to ensure that the company lodgements are ready and lodged with the ATO in the due time. So that was within 3 months for PAYG, withholding, and GST, and by the due date for super. So with the non-lockdown DPNs, there are 4 options that are given. The first one, obviously, clear, pay the amount of debt in full. Obviously, there are different ways that you can commercially look at to pay a DPN, but that's obviously the easiest way to get out of it, is just to pay it. Appointing an administrator and appointing a liquidator, if you do that within the 21 days, the company's debt stays with the company and there is no liability passed on to the directors. The important aspect for that is to ensure that it's done within 21 days. Once you pass that, you don't get that option to do it anymore, and the DPN attaches to the directors. And the 4th option there is to attempt to defend the DPN. There's only really 2 defences that are available to a director. One of those is illness. You have to prove that you were unavailable to work due to illness at the whole portion of time that the DPN is liable for, so all the time that the debts were incurred. If you can't prove that, then it's not a defence that can get up. And then the other one is to ensure that you have proven to attempt to get out of the DPN. So what you need to prove for that one is that the director tried to do these other options, tried to pay the debt, tried to appoint an administrator, and tried to appoint a liquidator, and was unable to. An example of where that might get up is if there are multiple directors, and one director tried to do these things, tried to call a meeting of directors to appoint a liquidator, and wasn't getting buy-in or assistance from the other directors. That individual director that was trying to do what he could to get out of it may be able to get out of the personal liability for himself. And there is cases where that has happened, but it needs to be shown that the director took the reasonable steps and proved that he took the reasonable steps to get out of the DPN.
Frank, I think it's fair to say the top 3 options are the most commonly utilised one.
I'd say so.
Obviously, the first one's obviously the best outcome, but defending a DPN is probably a pretty rare circumstance. Yeah,
it's not easy to defend, and there isn't many cases to show that. So what happens when you don't comply with a DPN notice? So there are consequences, and the way that it usually flows through is the director becomes personally liable for the tax debt. So the way DPN works is there's company debt, unpaid, the director becomes personally liable for that tax debt. It's not necessarily a separate debt, it's the same debt that just applies to both the director and the company. The ATO may begin commencing legal action against the director personally. And the way they'll do that is go through the process of issuing a bankruptcy notice and potentially commencing bankruptcy proceedings against the director. That could result in the director becoming bankrupt due to the DPN. Another option which may come through to that is the ATO issuing a garnishee notice upon the director and getting access to their income through that and through those means.
A common one there for garnishee is directors' personal tax refunds.
Yes.
Getting
access to those and clawing those back through their garnishee notice.
The director goes about and lodges their tax return via their agent and expects a $10,000 tax refund and is going to rely on those funds for whatever, and all of a sudden find out the ATO hasn't forgotten they've got an unexpired DPN that's sitting out there.
Exactly right.
Yeah.
So just going through the conclusions on DPNs. So some of the key points to take away from this: always ensure that lodgements are made on time, or at least within 3 months for PAYG, withholding, and GST, to avoid the lockdown DPN. It's pretty clear that once you get a lockdown DPN, you really have no options. So to minimise the risk of doing that, always ensure that the lodgements are made within that time frame. If a director of a company is issued with a DPN, it's very important to act quickly, especially if it's a non-lockdown DPN. The 21-day countdown does begin from the date of issuing the DPN and not the date that it's received. So acting quickly, as soon as you get it, try and work through the options that are available to avoid that personal liability hitting the director. And then it's always good to know that the director can escape personal liability if it does what is required in the DPN.
Hopefully everyone's been paying attention at home. I'm just going to go through a couple of questions and hopefully give you a moment to answer at home. And Frank will present us with the answers. So, when must tax lodgements for PAYG and GST be made to avoid a lockdown DPN?
Okay, yep. So there's the answer there, within 3 months of the due date. So again, this is the point that we are reiterating through this presentation, and it is the important one. Getting the lodgements done within 3 months of the due date avoids a lockdown. It gives you more options should the company be unable to pay their debts and get a DPN. Having the lodgements due up to date and lodged on time allows the company to have a bit more flexibility, potentially appoint an administrator, and get out of that personal liability.
Thanks, Frank. So second one, give you a chance to have a read and answer at home. So a client has issued a 21-day non-lockdown DPN on the 2nd of February. The DPN is received at the director's residence on the 6th of February, some 4 days later. And then on the 25th of February, the company's accountant called the ATO to attempt to enter into a payment arrangement for the company debt that's subject to that DPN in order to avoid personal liability for the director. Is this an option available to the company and to its director?
The answer is no. This one it's a bit of a tricky question in the sense that there are two reasons why there's a no. The first one is the date. So that 21 days begins on the 2nd of February, not the 6th. So they are out of date. And the second reason is that entering a payment arrangement isn't an option to get out of a DPN. And if you want to enter into a payment arrangement with the ATO, this needs to be done before the DPN is issued, and it needs to be done for the company debt. The ATO very rarely, most likely never, enters into or allows payment arrangements once it gets to the point that a DPN is issued, and you can't enter into a DPN, into a payment arrangement to get out of the DPN. So there's the two reasons there why that is a no.
Fantastic. Thank you, Frank. Thank you for tuning into this version of William Buck CPA. As always, if you have any questions, feel free to sing out. Thanks for your time. Have a good day.
Thank you.